All right, we are live. Hello, everyone, and welcome to the new and improved Stock Market After Hours. My name is Mark Rusin. I'm a CPA here in the state of California. Hopefully, you guys can see me, and hopefully, some of you enjoy this new time. I know some of you are going to say that we want the old time back, but we're just here to try new things. So, if you're out there right now tuning in at 3 p.m. here in the Pacific Time Standard, and if you are on the East Coast at 6 p.m., let me know where you're tuning in from and what stocks have you bought here in the past week. We're only 2 trading days into this week since we had Labor Day. Hopefully, all of you had a nice, relaxing Labor Day. I know I did. Kind of just hung low here, hung with some friends and family. So enjoyed that time off. So let me know where you're tuning in from. I see Scott asking if the 6 p.m. Time slot was a typo. It was not a typo. This is a new time that we're trying out here. Just to kind of switch things up a little bit and see what works for different people. I know a lot of people watch the recording anyways, so and we're not sticking to where we have to do it for an hour. We're just going to go through as much data as possible. Sometimes that'll be more than an hour. Sometimes that'll be less than an hour, but I just want to focus on bringing the best content and the most valuable information as it pertains to the stock market each and every week. So instead of saying we are the power hour and just talking about dividends, we're just going to say stock market after hours here moving forward. So hopefully, guys, let me know what you think of this new and improved. A lot of the same info. It's still me here talking about the stock market, both growth stocks, dividend stocks, ETFs, everything under the sun as it pertains to investing. So who do we got out in the audience right now? It looks like we have Terry. Hi from Delaware. Terry, hope things are going well for you. Mesa, Arizona. Robert, how hot is it over in Arizona? I'm here in Southern California. So for any of you that are here in the Southern California area right now, we are going through a heat wave. And I know, Costco's got all their Christmas stuff up and Halloween decorations, but it is 100 degrees here. And I'm only about 8 miles from the ocean, and it is pretty warm. So Minneapolis, Drew, good to see you. Long, good to see you as well from Chicago, Yorkshire, UK. Thanks for tuning in. Blue Sticky, Duke, and Florida. Anthony's in the house. Malaysia, awesome, great to have you, Anthony. Asheville, North Carolina. Monica, hope things are going well there. Tuning in from Chicago, so Chicago is dominating right now. Bought some shares of SPY, SCHG, and NVIDIA. So Kenny's buying a little bit more in tech right now, given that we had a little bit of that tech sell-off. We saw NVIDIA down 10% just in the past 2 trading days. So, okay, Robert, you outdid us there a little bit. So I guess it's kind of maybe it's a southern West Coast thing that's going on, this heat wave right now, because 112 is pretty hot, and it's not that hot here. Okay, so Shatan can probably vouch for me how hot it is here, because he's out in Cyprus, which isn't too far down the road there. The heat wave is coming up here also, and Jeffrey's up in Washington area. Supposed to be 101 tomorrow up here, Seattle, Washington. That's pretty hot. Hello from Atlanta, nibbling on TMF and thinking about rotating into more treasuries. Talk a little bit about where the treasuries are. HUD from Florida, have a few dollars set aside to pick up some more OHI, some Pfizer in a lower September. Jacob tuning in from St. Louis. Greetings from Switzerland. Awesome. Great to have you, Sylvan. Bought some PM, some Berkshire, and a little Walmart action. Okay, Texas in the house. Howdy. Is it Cibolo? Is that how we say it, Kevin? Greetings from Portugal. Okay, we are going international. So we got Switzerland so far. We had Malaysia, Portugal. My buddy Sean usually tunes in from Singapore on here. Hopefully the time was more helpful. Netherlands, look at this, guys. We are going global here. We got Columbus, Georgia in the house here. I guess it's not as much global, but maybe it's cross country since I'm here in California. So awesome. What are we buying? I know you guys are telling me where we're from, but also let me know. Are we doing any buying, or are we just kind of sitting back and relaxing? So if this is your first time tuning in to one of our live shows, welcome. Again, my name is Mark Rusin. I'm a CPA here in the state of California. And what we like to do on these live shows is I just like to go through kind of discussing some key economic topics, look at a few stocks, some big movements, maybe some earnings and things like that, just to help you be more well prepared for the weeks and months ahead. A lot of things that we've discussed here in the past few months have been around REITs. What have we seen from the REIT sector? Just the best performing sector the past few months there. So, we're kind of a group here we all have one goal in common. That is to build generational wealth. build generational wealth to leave a lasting financial legacy for friends, family, whoever it may be from that standpoint there. And that's kind of been the sole purpose behind, kind of my mission as it pertains to coaching folks, doing all of the webinars that I do and things like that. And many of you that have taken my one-on-one investing accelerator course can vouch for that as well. So, and I appreciate all the opportunities I get to work and speak with you guys each and every week. So thank you guys tuning in, and let me know what you think of this new format here. Again, a lot of the same information, just not holding ourselves to a full hour if we don't have to. We can go over, we can go under, just making sure that we continue to harp on the key topics and the important things to kind of discuss year in or week in and week out from that standpoint. So let's look at our slides here, and I know everyone loves the economic update, so we always like to kind of refresh and see where are things at as it pertains to the stock market right now. So our year-to-date figures, we can see the Dow Jones and the Russell 2000 are kind of our laggards, but everything's green from that aspect, so there's going to be no complaining. Dow's up 8.7%. The Russell's up 6% so far on the year. The NASDAQ up 13.8%, although it's struggling a little bit of late. And then we have the S&P 500 up 15.7%, which is the leading indice of those four that we just looked at. However, on the far right, though, or next to it, you could see the last 5 trading days, which hasn't been all that great across the board. The NASDAQ down nearly 4%, S&P 500 down roughly 2%, and that's the last true 5 days, which has only been a few trading days there overall. We didn't have anything on Monday. Looking at valuation right now, we were up over 21 times on a forward-looking basis. Again, S&P 500 typically around 17 times. That has increased over the years as technology and higher multiple stocks have kind of become a larger weighting of the S&P 500. So we've already moved up the average per se a little bit, but now we're well above that. I mean, we are sitting right around 21 times right now, historically right around 17 over a 10-year period. So pretty stretched from a valuation standpoint. And let me tell you this, folks, if you're new to investing, anytime we get stretched valuations, that is investors looking for further growth. But when you pay for high multiple stocks, high multiple indices, ETFs, whatever it may be, and the earnings don't come through based on those expectations, those stocks fall a lot harder. Those stocks fall a lot faster. That's why some folks say, hey, I don't even want to deal with any individual stocks above a PE of 20 times. If it has to do with the volatility of a stock, I understand that. But at the same time, there's ways around valuation to understand if it's a high multiple stock, but does the growth make sense? And those are a lot of the metrics we look at within the 6-week investing accelerator course. So right now we're at 20.8 times, historically around 17.9 over the past 10 years. And that's based on a forward-looking estimate of $265 right there. Based on interest rates, that continues. Each week that we have this live show here, we have seen interest rates continue to come down. And last week they were at 3.84 on the 10-year, 3.87 on the 2-year. Lo and behold, here we are neck and neck on both of those. Not really much of the reverse inversion quite yet. They're pretty much exactly the same, but both of them have come down yet again. So 3.76 on the 10-year, 3.77, pretty much spot on both of those right there, but both of them down a significant amount in the past week. So what have we had this week? And what do we have to look forward to this week still? Still a lot of information to come. Well, today we got the big JOLTS report. That was one I was looking to in a big way. And that shows us what the JOLTS report does is it reports job openings. And this can be a big predicate. It could be a big data point for us as investors to understand where is the economy. Because if there's companies out there that are hiring a lot faster, they usually hire today for future. And if those hiring numbers are coming down, especially right now, the hiring that's going on today is setting companies up for the holiday period. And the numbers that came in today are quite scary because a lot of these retailers are really focused on the holiday. Think of companies in all of the different retail sectors. We had Dick's Sporting Goods that came out today. Amazing report. Light guidance, concerns about future guidance. Yet another retail company with concerns about future growth. Dollar General cratered last week. We've seen it from Starbucks push back on pricing. We've seen it from the likes of McDonald's, which can, that there's all income levels that can go to McDonald's. And if they're not seeing a pickup when prices are high, that's a little concerning there as well. So a lot of retailers out there giving us light guidance. concerns about future growth there moving forward overall. So, things to keep an eye on as we progress. So when it came to the JOLTS report, you could see 7.67 million job openings. That was down just from last month, folks, down nearly 240,000 jobs. What did analysts or economists expect for this JOLTS report? 8.1 million jobs. That was a massive miss. I mean, we are talking about hundreds of thousands of jobs that these economists were off there. In fact, this is the lowest level that we have seen since January of 2021. So that's all of 21, all of 22, all of 23, and now 8 months through 2024 is the last time we have seen the JOLTS report that low there. Jobless claims come out tomorrow, so we'll get an update to see where those are at. Those are on a week-by-week basis. And then the all-important August jobs report is going to be coming out on Friday there. So let's stay tuned. There's still plenty to come, plenty to rock this this market here. So definitely interesting. So let's look back here at the slides, or I should say the comments, and see what folks are buying. So we had Columbus, we had Miami, Dominican Republic, Raul's in the house, Brazil, Rich. What are we buying, Rich? A little DGRO, SCHD, and QQQM. Matthew, good to see you. URA the past 2 days. Global news from the U.S. market. Buying QDTE. Michael saying hello. Look for Microsoft. They're going down. Saving up right now. Was hoping to look at some Cube and some REXR. A couple REITs there. Love it. Ohio here. What's your thoughts on weekly paying stocks such as QDTE and not ones that I pay much attention to? I look at things like JEPI or JEPQ. They could be useful for an area to kind of place and park some money in the near term, but I'm never going to have a position in those that I'm going to say, hey, I'm entering a position and these are for the long term. I expect to have my money in here for 3-5+ years. Not something I do. Part of the reason behind that is, number one, higher expense ratios, although JEPI and JEPQ aren't all that bad for how much they're trading all the time. But the other reason is that I generate a lot of income on my own. And I'm doing it on a lot of stocks that I wouldn't mind owning and buying at cheaper prices and things like that. So that's a big reason on why I don't do many of these zero DTE or short-term monthly focused income type plays like that. NVIDIA, Amazon, let's go. So if you guys have been kind of paying attention here for the past 2 months now, the Mag 7 hasn't been performing that well for 2 straight months now. They've been the leader. We've become accustomed. A lot of new investors look to the Mag 7 to say, hey, carry the torch. In 2023, we were up 20+% in the S&P 500, but much of that had to do with the Magnificent 7. In all reality, when you see the S&P 500 up over 20%, you think to yourself, okay, the economy's doing pretty good. There's a bunch of companies that are doing pretty good, but we saw the gap. We saw the gap between the S&P 500, which is going to be market cap weighted, meaning the largest companies carry the most weight. And then we compared it to what's called the RSP, which is the equal weighted S&P 500. And we have seen the largest gap that we have seen in decades. That doesn't tell me that the entire thing is working. That tells me that there's a few, very select few stocks that are actually working out there. So what is going on now shouldn't be that much of a surprise to us as well, because now we're starting to see those Mag 7 stocks cool down, which is necessary. And we're starting to see it sprinkle, something we've talked about on this channel a bunch, that look for the broadening out. Which ETF works great when things broaden out? SCHD. And don't say we haven't talked about SCHD, whether you've watched a video on this channel, whether you've watched the live show on this channel. SCHD, you could look at today, and lo and behold, they're making new 52-week highs on a regular basis now. What does that tell you? That tells you that, hey, the tech trade is taking a break. Folks are taking their gains and they're saying, hey, this has worked for 2 straight years. It's not something that can just work for 10 straight years and we see outperformance from the Mag 7. No, now we're getting into real investing. This is where we really can separate, folks, because a lot of people that want to pour money, retail investors could pour money into technology, they could be left behind. Why? Because it's more of a YOLO trade. They're getting left behind. You need to see what the big money's doing, because that's what moves the market. The big money is selling out. We saw it from all of those 13F filings. Buffett selling out of the likes of Apple, selling out of Bank of America, which I didn't like that one that much. You saw the other massive hedge funds selling out of mega cap tech. It was just one after the other. There was not one that you went through where they said, oh, they just bought NVIDIA and that was it. They just went all back in on Mag 7. No, 80% of the largest hedge funds, that if you follow any of them, it was sell parts of the Magnificent Seven there. Now, does that mean I'm going and selling my Magnificent Seven? No, absolutely not. Does it mean I'm rushing to add a bunch more exposure? No, not at all either. It means I'm just holding my positions right now. It's okay to still be a little overweight tech, but folks were getting so overweight into one particular sector that they're now looking at their returns saying, things aren't going anywhere right now. Why isn't all of a sudden things aren't working? But the S&P 500 keeps climbing. Again, it's market cap weighted. And that's why we want to be diversified, because when there's certain sectors that don't work, there's other ones that could pick it up. When technology is not working, SCHD is going to pretty much cover every other sector in the S&P 500, with the exception being real estate. They don't invest in any REITs, but as you know, with my portfolio, I invest roughly 15% of my portfolio in individual REITs. So I'm covered there from that standpoint. It's very important to be able to diversify your portfolio from that standpoint. So let's continue on here. Let me pull back up the slides here for you guys so you can pay attention there. So we got the JOLTS report that came out today. We'll talk more about that here in a second. And then we have the jobs report that's coming out on Friday with the jobless claims and continuing claims that are going to be due out tomorrow there. So be on the lookout for that. So here's a look at the fear and greed index. We look at every single week. And lo and behold, if you were to go back 12 months and exactly a year from today and look at where the fear and greed index was, it was in the exact same spot, sitting right in neutral. And why is that? Investors are kind of curious on what direction are we going right now? Where is the stock market headed? And we've talked about it in the weeks leading up to September. September is historically the worst performing month for the S&P 500. There's a lot of tax loss harvesting that goes on, where a lot of folks are kind of positioning their portfolio, rebalancing their portfolio for the final run in Q4. So if we're rebalancing and we're taking off a bunch of gains or we're selling losers, what does all that have in common? Well, if you're rebalancing, you have to sell positions. If you're taking gains, you have to sell. If you're taking losses, you have to sell. Selling pressure. There's more selling than there is buying. And when there's more selling, markets come down. That's historically why we see the S&P 500 not have a great month in September. We have in case you haven't heard, a presidential election this month, which can throw things out of whack a little bit, based on which candidate is leading in the polls or heading into likely to win. That could be up or down for the energy sector. You never know what's going to happen from that standpoint there. So we'll take a look more at that. So now let's keep going here and let's take a look at our sector performance. So let me share the screen with you and let's take a look at our sector performance overall. So here's a look year to date. We could see the top sector is information technology, followed by financials now. Communication services has taken a back seat here. For the past 18 months, it's been technology and technology and communication services at the top there. This is the first time, for those of you that have watched this show for a while, that we have seen communication services not in one of the top two spots. It's not just not in one of the top two spots, it's fallen down to fourth here. That can change very easily because they're only a few basis points behind utilities and financials there. Quite intriguing, though. Infotech isn't that much in the lead either. So we could see a point to where financials is going to be the leader here moving forward. And staples. So when we look at the top 5 sectors that are leading year to date right now, there's some interesting things that are starting to take place here. Infotech, to a degree, can be thought of as somewhat defensive because it's really been working in any economic backdrop. But when you think about financials is something that can work in either late stage or early stage. When you look at something like utilities, first thing you think of is very defensive. When you look at something like consumer staples, you think of very defensive. Then the next few that you look at, healthcare, you think of very defensive. So you're seeing an uptick in the sectors that folks are putting their money towards, and it's getting a lot more defensive and a lot less of those risk on. Investors are concerned about the economy, the slowing economy. We've seen it all across retail. There's not too many retailers that you can point to today that say, hey, they are upbeat. There is some big time growth coming for this particular retailer. We already mentioned a bunch of them. Starbucks, Dollar General, all of the dollar stores that you could throw in from that standpoint. Look at Walgreens. What a mess there. Walgreens, Dollar General, that's just been a complete disaster there overall. two large tenants in the likes of Realty Income, which is why I've been trying to talk to you guys more about less Realty Income, more Agree Realty, where you got Walmart and Tractor Supply as the top two tenants from that standpoint. Two companies I like a lot more. So maybe there's one particular retailer that's a little bit more upbeat, and I just mentioned it, which is Walmart. We have a lot of folks that already shop at Walmart. You have some of the higher income folks that are maybe trading down and checking out, using some of their funds on a regular basis to go to Walmart to save a little bit. Wallets are getting tight, folks. There's no question. There's no economic data that you can look at that doesn't justify that economy is slowing and wallets are starting to get a little bit more tight from that standpoint. We talked about the data point last week that this is the highest rate, and there was a survey that went through the highest rate of folks that are employed right now, but concerned about the next 3 months of their jobs. Employed right now, but worried about getting laid off in the next 3 to 6 months. It's at a peak that we've seen in the past few years there. So definitely something to be mindful of when it comes to investing right now. Invest with a purpose, but understand, don't just look and see, oh, NVIDIA was down 9%, let's buy the dip. Because if you look at support levels as it pertains to NVIDIA right now, support's closer to $90, $95 right now. And if it breaks that, it could drop closer to 80 or below from that standpoint. Not saying we're going that low, just kind of pointing out where support levels are overall. So invest with a purpose right now as it pertains to some of these tech stocks. So let's do an audience question right now. So let's put that up on the slide. Which of these sectors, we've talked a little bit more about sector performance, rotation, and things like that, but which of these sectors do you pick to perform the best for the rest of the year? Is it technology? And I didn't put all 11 up here. We just didn't have room. But technology, financials, consumer staples, REITs, energy, or utilities? Drop it in the comment section there and let us know which of these sectors do you pick to perform the best for the rest of the year here. Tech, financials, staples, REITs, utilities, and energy. And if you were to ask me right now, I would probably lean a little bit more towards, I'm upbeat on financials. I'm upbeat on financials right now. And let me tell you why, is because we're talking about interest rate cuts. REITs are up there, but REITs have had a big move right now already. So if we're talking about, we have a clean slate right now for the remainder, 4 months that we have left until the end of the year. Can you believe that? There's only 4 months left in the rest of the year. That's right? Someone fact check me on that, since everyone's big on fact checking now. Hopefully you can fact check me and tell me there's 4 months left. But if you look that we have this interest rate cycle coming where interest rates are going what? Up? No, they're coming down. So you might look at it from one angle and say, okay, well, when you got financials, think of a bank. There's going to be lower rates. Lower rates means less income for those loans that they can make. But if you think about it, lower rates, there's a ton of companies. There's a ton of consumers, people that want to buy into homes, small businesses that want to add for future growth and maybe take some loans out. They may have just been sitting on the sidelines saying, I'm not really interested in 7 and 8% interest right now. But if that comes down to 5 or less than 5% interest rates, yeah, I'm all in. I could go get a home for that, for a 30-year mortgage. I wouldn't mind that. And if it keeps coming down, I'll refi. But I don't want to start at 7 or 8 and see how long that stays there. Small businesses don't want to get locked in at 7 or 8, even higher, depending on their credit, and start there. That's a lot of interest expense. So they may have just been waiting and say, hey, let's just ride this out. Interest rates are going to come down. So when interest rates come down, that's going to increase loan growth. So these banks may be getting less on every loan that they do, but they're going to have more in terms of volume potentially. As long as the economy can stay put together. Economic news is showing a decline overall in the economy. We just don't need a crash. As long as it can stay together, we're going to be okay from that standpoint there. So definitely take a peek and keep an eye as it pertains to financials. And, one of the ETFs that you could look at is going to be XLF. So that's going to be your just broad financial sector there. Financials can include things like credit card companies, Visa, MasterCard. Financials can include banks, large or regional type banks. I'm more of just a large one. It's either JP Morgan or Bank of America for me. I own Bank of America. I own Visa. I don't need Visa or MasterCard or American Express. I just need one of those three. I've had Visa for a long time. So I have Visa. I got Bank of America. I have some brokerage exposure to a company like Schwab. You have Schwab and Fidelity that's out there and things like that. You could do a T. Rowe Price I've had I've owned in the past. Great dividend growth, just the stock hasn't gone anywhere. So I prefer kind of those three. Don't you could have insurance companies that fall in there. So it's a broad lens in terms of financials from that standpoint, but definitely a sector that I'm looking at. But there's a lot of other ones that can definitely outperform. You got utilities and REITs, like many of you mentioned there. More REITs there. More REITs. Look at it. I think REITs is going to win the day here. Jordan's with me on financials. More REITs. So it's pretty much financials and REITs, scrolling through these just quickly here, followed by probably utilities or staples. Very interesting to see that, not many people going with technology. Not saying no one, but not many people going with technology there. So question down here. Mark, are you still bullish on O? O has a fantastic set of assets. One of the best asset portfolios, over 14,000 properties. And the reason that you know this is these are properties that are in demand, regardless of what the economy is doing. If you look back over the past few decades, pretty much since Realty Income's been around, you will see that their occupancy rate is always above 95% overall. And the reason being isn't because they just offer cheap rents. No, they have high quality properties that are in demand. Retailers and companies alike want to get into their properties because they know traffic is at those locations. But when you look at the tenant base, those are some concerns that I have voiced over the past few quarters here. Having a CVS and Walgreens and Dollar General and Dollar Tree are not companies I like to see at the top. So that's my kind of X when it comes to Realty Income, the great golden child. I know. I still like it. I love the management team over there. I have interviewed the CEO a number of times, and they will get it figured out. Just like when we went through the pandemic, they had high exposure to theaters. That has now been reduced. So I mentioned the actual tenants that I have concerns about, but when you look at the tenant base also, to kind of flip the script a little bit, because they have so many properties, their exposure rate in terms of annual base rent, that think of it as, okay, this is how much they collect in total rent on an annual basis. I think their largest tenant might be 3.5% overall. So we're not talking huge numbers here, huge percentages overall. If one of those top companies went, belly up and they were just gone, they'd be able to probably get someone in rather quickly and probably step up those rents a lot faster to more market. So it wouldn't be the end of the world. And that's one reason that I'm still holding on to Realty Income. They were at a cheap rate. They had a nice little run, but they probably don't deserve the premium that they once traded at as compared to the net lease sector there. So something to think about. Look at Agree Realty for the other side of things as well. So just something to mention there as well. So another thing that I want to mention to you guys right now is starting next week, and we launched this for those of you that were able to join our free webinar last week, is our Investing Accelerator Academy. This is our premier group coaching. This is the same, 70 to 80% of the content you would get through one-on-one, you're going to get through in a group coaching format. So whether you're able to join us live every Tuesday at 8 p.m. to go through this, it's a 6-week program. We'll go through how to analyze stocks, how to value stocks, how to construct your portfolio based on your personalized profile. How much risk are you willing to take? This is how a portfolio should look. How conservative are you? This is probably how a portfolio should look. We'll go through ETFs and index funds, things to look out for and things to look for in particular ETFs and diversification and stuff. So the Investing Accelerator Academy, it is open, and we have a few founder prices right now. So once those founder prices sell out, prices will increase for the rest of the folks that want to join the Investing Accelerator Academy. So if you're interested in this group coaching program, check out the link down in the description below if you want to take advantage of one of those founder pricings down there also. So but as I mentioned, even if you're not able to join us live, all of the recordings will be there for you to take at your own pace. So maybe you had to miss one that's a live session, catch up with it with the recordings, all the handouts, the slide decks will all be there within our private community that we have, where you'll be able to ask questions, fill out and enter your homework items and things like that. So if you're serious about investing and navigating this market, especially during the month of September, and gearing up for not only the rest of 2024, but beyond, the things that you're going to learn, especially as we go through our valuation checklist and all of the detailed things that you want to make sure that you look at, especially when you're buying individual stocks, this is going to set you up for a successful financial future here, folks. Doesn't mean every stock that you buy is going to be a home run and you're going to 10x your money, but you're going to be set up for future successes moving forward. And we go through a whole section on REITs, how to value REITs. So I have a whole valuation tool for both traditional companies as well as REITs. Those are some of the handouts that you'll get access to within the Investing Accelerator Academy. So check out the link down in the description below if you want to claim one of those last few founder price spots there as well. So let's now focus on the jobs market. So let me turn our attention back over here and we'll take a look at our jobs opening. So let's take a little bit more detailed look at that JOLTS report. And again, this is the lowest level in terms of job openings we have seen in the past 3.5 years. We had 7.67 million jobs openings there. That's down 237 just from the prior month from that standpoint. That's big time. That's a big miss, especially when we look at economists who surveyed, we're looking for 8.1 million overall. So be mindful of that as well. And the other stuff that we want to look at is I want to go down here a little bit more and talking about what are the details within that JOLTS report there overall. And we could see that not only has the number of job openings declined, layoffs have gone in the wrong direction. Layoffs are up to 1.76 million. Now, this is nowhere during the peak of the pandemic, but these are climbing and these are heading in the wrong direction there overall. Total separations, this could be a layoff or this could be someone just quitting their job, jumped by 336,000 people there from that standpoint there. That is up to 3.4% there overall. So it's going to be key to look at the jobs report here on Friday, because what we have seen for what it's been 4 or 5 straight months is an uptick in unemployment. At the start of this year, we were at about 3.3% unemployment rate. Lo and behold, as of the last jobs report we got for July, that was at 4.3%. So is that something that is continuing to climb? Are we going to see 4.4, 4.5%? If we get into the high 4s or even cross 5, that's when I'm really going to be concerned a lot more moving forward. Low 4s, it's concerning in the direction we're moving right now. Not overly concerned on the number right now because we're kind of, gaining towards that historical average per se. No one wants to see anyone lose their job, but it's kind of giving more ammunition to the Federal Reserve in terms of we need interest rate cuts ASAP. So it's not about if they're coming in September, it's about how much. Are we going to get 25 basis points or are we going to get 50 basis points? And remember, when it comes to investing, it's less about what you did for me today and more about what you're going to do for me. It's about forward looking, not where the economy is today. Where's it going to be 3-6 months from now? That's what you have to be thinking about as an investor here. That's why we're seeing a lot of folks get worried about the NVIDIAs of the world, the Alphabets of the world, the Microsofts of the world, so on and so forth from that standpoint. So there's going to be times and opportunities to jump into those at great valuations. But if the valuations come down, but at the same time, the growth rates are starting to slow, you see a bunch of analysts go in and say, hey, I know we thought the company was going to grow 20%. Now it's only 15%. Well, the stock price coming down, it actually may be more expensive than it was earlier on because you have to adjust for the growth. You can't just say, oh, the stock was at 200, now it's at 150, it's cheaper. That's not necessarily the case. Because if you look back over the past 12 months and you looked at NVIDIA when their growth was cranking up and pre-split when they were going from 550 to 750 to 850 to 1200 to 1300, when you looked at over a 12-month period, even though the stock had gone parabolic, it was actually cheaper from a valuation perspective than it was the prior 12 months from that standpoint. Not cheaper in stock price, cheaper in valuation, just based on the growth that they're expected to have moving forward. Definitely something to be mindful of there overall. So let me show you guys. Let's do a quick video here really quick and that I saw that I thought would be helpful in terms of the JOLTS report. So it's a pretty quick one overall, so nothing you need to be, you guys let me know. Hopefully you can hear it on and give you the full screen here. Let me know if you guys cannot hear it.
Got a couple of macro prints a moment ago crossing the wires. JOLTS comes in at 7.67 million. That is lighter than the estimates of 8.1 million, down from 8.2 million last month. And factory orders for July up 5. That is in line with estimates. That's going to be the lightest opening since January of 2021. And I know that's a number you like to watch.
Well, especially that $8 million openings mark on jobs, because back in April, we got below the 8 million, but since then it's kind of rebounded and hovered around that level. So we are now seeing more evidence that the labor market is cooling off. We're going to dive in just a little bit, look at some of the.
So that's some of the stuff that we've been talking about on this channel. It shouldn't be earth-shattering by any means in terms of what's going on with the economy, but these are some real concerns here. So is the jobs report, we've seen job openings come down. We have seen some details around the number of separations. We've seen layoffs increase and things like that. That gives folks a little concern about, hey, we might see a 4.5% unemployment rate come Friday. So definitely something to be mindful of. And this is why it's important as an investor to be mindful and to always have that money available. Always keep, roughly at least, 3 to 5% is what I say at a minimum in cash in your brokerage account, because we never know when opportunities are going to persist. And that's why it's so important to do your due diligence ahead of time. Do your due diligence ahead of time. Have that list of 5 to 10 stocks that says, hey, if this particular stock here drops to this level, that's a level I would love to buy it at, because you already went through my checklist there that said, go through all of these different metrics here and let's find a stock price that's going to be a lot more a discount. I don't like to buy things at fair value. It's just like, if you were to go to the grocery store, if you were to go buy new car, new clothes, you probably want to buy things on sale. At least I know I do. I never want to buy anything at full price from that standpoint. Stock market is no different. We want to buy things on sale, good value and on sale. But there's a big difference, though. There's a lot of things that can be on sale, but be on sale for a reason. I want to find high quality cash flowing companies that are performing well and on sale. I don't want to find companies that are on sale and not performing well. Starbucks is a great example right now. A company I own, not adding to. It is cheap, but it's cheap for a reason. They've increased prices, traffic has fallen. So they need to figure it out, because they can't really lower prices, or that's just going to eat into margins overall. But they have to find ways to be more efficient and ways to get more customers back to the stores there. So that's a good example of a company that's cheap, but cheap for a reason there overall. The other video I wanted to show you that I saw this week was around Tom Lee. And I know Tom Lee has gotten a lot of headline, but for the past few years, I know he's always a bull, but he's always been right. So even during the pandemic times, he was pretty spot on there overall. So definitely something to be mindful of and to pay attention to. So hopefully you guys can hear this one here as well.
Now with this call for the markets on the first trading day of September is Tom Lee, managing partner and head of research at Fundstrat Global Advisors, as well as a CNBC contributor. And all along, Tom, when you've made these prescient calls, some of them even short term, it had to do with positive surprises on inflation. And is that going to be enough from here on out to keep the market headed higher, or have we shifted to growth worries now?
I think there's probably more growth worries in people's minds these days. So the jobs reports and claims seem to have more market reaction. I think that's going to be the case in September as well. I mean, we have the Fed meeting sort of in the middle of the month, but this week is the jobs report. I'm sure there's going to be a lot of focus on that.
Right. So what kept you positive was that the numbers were always, for the market, they were better than people were thinking. Is that going to continue to be the case? But it's no longer inflation, it's now growth. So growth will continue pretty good. Jobs will continue pretty good. You're not worried about another growth scare like we had 6 weeks ago?
Yes, I think that the growth scare is what everyone's worried about, because the July jobs report was kind of a shock to markets, and that's part of how we.
That right there is not something that I necessarily want to hear. We are talking about an ultra bull here, guys. Tom Lee is always bullish on the stock market. And what we just said right there was Tom Lee is concerned. Holy Toledo. There wasn't seemingly anything in the past 2 years that concerned him. It was always just stocks up, stocks up, stocks up. Doesn't mean he was always right. But I mean, if I lined up two folks and I said, you could have Tom Lee manage your portfolio or Cathie Wood, I guarantee 99% of you are probably going to go with Tom Lee. I mean, if you look at his portfolio, he has stuff to back it up. If you look at Cathie Wood, you're just blowing money. You might as well burn it from that standpoint, because she has been just an absolute joke in terms of performance. She says, oh, give me 5 years. Look at the 5-year chart on all of her ETFs. Not only is there zero performance, but you're also paying a high expense fee from that standpoint. So those are two completely different folks. And Tom Lee, whether you like him or not, he's been pretty spot on for much of the past few years here. But now even he is concerned. And what he mentioned there that you could take away from it is we're not as concerned about inflation coming down because it seems like we have won that battle. The Fed is already alluded to that, yes, interest rate cuts are here. They're coming in roughly a few weeks here overall. But now we have to kind of turn our attention to what a lot of these retailers have been saying of late. And pretty much companies from all different sectors have been saying. It's all been around guidance. If there's one thing that you look at from this last quarter earning season that we just went through, most of the companies were performing quite well in terms of beating expectations. Where they were coming in light, and what a big reason for a lot of the stocks that went red after earnings was due to guidance, concerns about where we're headed from that standpoint there. And the writing is on the wall in terms of the economy here. So you need to set up your portfolio. That's what we're going to be talking about also within the Investing Accelerator Academy, is showing you, how do I know when to transition my portfolio? It's not just one where we buy and come back in 5 years and say, oh, let's see where it's at. No, if you're going to be managing your own portfolio, there's going to be some small tweaks. That doesn't mean we sell out of everything, but there's going to be some tweaks that you want to make. You want to increase certain sectors, decrease certain sectors. How do we know when to flip it back and things like that? There's going to be a whole chart that we go through that's going to be useful. I actually have it printed out on my wall, and many of the students that go through the program print it out and put it on their wall as well. It's something I revert back to on a regular basis, and it is so important to be able to, if you are looking to outperform and not have those 2 to 3% years, if you're looking for true performance each and every year. I mean, there's a reason that if you look at my portfolio, we've beaten the S&P 500 for 7 straight years. And I post my entire portfolio within the Investor's Edge. So it's not a secret to anyone from that standpoint there. So question here, how many stocks do you or must have in your portfolio? It's not about how many you need to have. I know plenty of people that just invest with ETFs and they make plenty of money. They're looking more for a little bit more hands off. But for me personally, I have about 50. And that's probably a little bit more on the higher side for a lot of folks, just because if you have a lot of individual stocks, it's a lot more hands-on work. There's a lot more of keeping up with the quarterly and keeping up with the valuations and what the company is doing and forward estimates and things like that. So, I usually tell people that say, hey, start with, a 10 or so, a dozen. That includes ETFs, building out, that portfolio from that standpoint, and see what the workload is. If it's too much, lower it. If you're looking for more exposure, higher risk, higher reward, and want individual stocks, okay, then you can start adding a few little by little. But once you get overwhelmed and to the point where you're like, hey, I'm not even keeping up with this company, I've lost a bunch of money on it, or whatever it may be there, that's telling you that you have too many positions from that standpoint there. So, Buffett has talked about it before, about the keys to diversification, but you can be over diversified. I've had many students that come in with over 100 different ETFs, index funds, individual stocks within their portfolio. That's way too many. There's no one out there that can keep up with that many stocks from that standpoint there, and how your portfolio is doing and things like that. So definitely some stuff to be mindful of. So hopefully, if you're serious about investing, and whether you're new to investing or whether you've been investing for a few years, definitely check out our Investing Accelerator Academy. It's going to be this is our next cohort that'll be starting next Tuesday, 8 p.m. Eastern time. We still have a few spots left for the founders pricing. That's what they're going to save you $500 off the full price from that standpoint. So we just have a couple of those left. So if you've been on the sidelines about wanting to jump into this, now is the time to do that with those final few spots that we have starting next Tuesday. And I hope to see many of you in there. So let's now transition over to the Fed here. And taking a peek, let me take this one off here, on seeing where are we in terms of interest rates. So let me transition, stop sharing my screen there, and let's go to this window right here, which we look at our Fed futures. So this number has changed drastically. This is a number that was at upwards of 65, 70% not too long ago. You can see just a day ago, we were sitting at 62% in terms of folks thinking that, hey, we are going to get a 25 basis point cut. When you're looking at this column on the right, that is indicating a 25 basis point cut. The far left column over here, which is 45% chance in terms of this futures here, is indicating a 50 basis point cut from that standpoint. So again, as you can see here, it's not a matter of if they're cutting, it's a matter of how much. Are we going 25 or 50? And with the JOLTS report coming out showing that, hey, we are seeing a very weak labor market overall. We need to not only cut rates, we need to ramp those cuts going a lot faster here. And we need to do multiple 50-point cuts here in this year. So we got 45% now. And as you can see, that is jolted up there. So let's look out to November. And we look out to November, we're thinking that 50% thinks we're going to be at a full 75 basis point cut from where we're at today. So just be mindful of that we're indicating 75 basis points. And then the last meeting, so there's 3 total meetings left in the year. The majority of folks believe we are going to end the year at 425, which would mean it be a full 100 basis point cut. Whether that comes 50-50, whether that comes 50, 25, 25, I believe they're going to skip in November just to stay away out of all the election stuff and come back and do another 50 in December. That's something I've kind of stuck to, is saying, hey, we're going to get 2 cuts here in 2024. And for those of you that have watched this show, you can attest to me saying and believing we're going to get 2 cuts. Is I believe we're going to get 50 here, and we're going to get another 50 on the back end right before the end of the year on December 18th there. So that's where I believe things are going to be as it pertains to the jobs or the Fed funds rate there. So let's focus a little bit more here on jobs before we close out, and I'll take a few questions there. So we had Broadcom and Dick's Sporting Goods in terms of some big earnings reports this week. Closer look at unemployment, or the job market, I should say. And you could see, and this is pretty much from the start of 2022. So this is the past few years here. We could see the total non-farm payroll just on the gradual decline. On the flip side, we have seen unemployment, and you could see unemployment at the start of this year sitting in the mid to low 3% range. Now we sit at 4.3%. So we have gained 100 basis points from that standpoint, and it has just been a one-way train higher and higher pretty much for the entirety of this year. So definitely, is that going to pause, or is that momentum continuing to the upside, which is not great for the labor force if we've seen that? I spoke to this at the start of our show today, talking about the Magnificent Seven. And this is what I was alluding to. And you could see how the Magnificent Seven has performed as compared to the greater S&P 500 index. And what we see here is that for the past 2 months, July and August, the Magnificent Seven, as it alluded to up top here, haven't been so magnificent. It has been a gradual decline, underperformance as compared to the S&P 500. And we haven't seen this type of underperformance since dating back to December of 2022. So it's been a few years. And that's when the whole 2022, we saw that was the last time we came across some market turbulence. Stock market fell roughly 22, 23% there overall. So this is starting to creep up. We're starting to see that broadening. And what does broadening do? It's great for an ETF like SCHD. And that's why I tell you guys, SCHD is such a great, it's okay to have that tech. Overexposure to tech, that's fine. Just don't be too overexposed. Don't have 70%, 50% of your portfolio towards one sector there. But if you do want to be heavy tech, but still be diversified, SCHD is going to do that for you guys. Because again, if we look at this sector breakdown, technology is only about 10%. You get exposure to financials. You get exposure to healthcare, consumer staples, energy, industrials. And someone that has a lot of tech probably isn't investing a ton in all of those sectors there. It is a great complement. When tech comes down, communication services come down, SCHD is going to pick you up. It hasn't been there when technology has been a one-way or two-way, I should say, with communication services. And folks have been, they wanted to jump on the old SCHD train anytime we had a video come out. And I said, hey guys, just wait. Just wait. Because when tech takes a break finally, a lot of people got into investing the past few years, but when tech takes a break, don't come running to me saying, hey, what was that ETF you mentioned? It was DSC or what was it, Mark? Well, lo and behold, here we are at a 52-week high. And we got SCHD back up in the mid 80s there overall. We're up, what are we up on the year? 10% on the year right there. And we're starting to move. We had this thing down to $75 in April. And lo and behold, we're up in mid 80s there. So plenty of room to go. Plenty of room to go as it pertains to SCHD, but it's trading at new all-time highs. So there was a lot, better timing to get into it. But if you're looking to diversify your portfolio, keep this on your watch list, because if we get one of those market-wide dips here in September, where just everyone's selling everything, this is definitely something to have on that watch list that we talk about. So definitely be mindful of that as you are investing. Don't wait for the stocks to fall. Don't wait for NVIDIA to come down 10% and then go and look at all and do your due diligence really fast. That's that's doing it backwards. And that's what we teach in the Investing Accelerator Academy. How do I look? How do I do my due diligence? What are the things I want to look for to know that the liquidity is strong and the balance sheet is strong and the income statement is progressing in the right direction and the cash flow statement? I've never looked at any of those. Those are the things that we do within our Investing Accelerator Academy. So hopefully you guys are going to join it. And I know I already saw one person sign up because I saw the notification come across. So again, if you want to take advantage of that $500 discount, there's a link down below. There's only a limited number of spots. If you've been on the sidelines, again, you don't have to join us live. If it's something where you aren't available on Tuesdays, all of the recordings are going to be published there. You still have access within the private community that we have to ask all of the questions. You can tack on and do a one-on-one training with me at the end of the session. Well, if that's something where, hey, I went through all of these, I got some questions, I want to look at my portfolio and stuff like that, book one of those as well. And you could do that on top of the Investing Accelerator Academy. So that starts next Tuesday, folks. So we only have a limited number of spots. I hope, if you've been on the sideline about investing and turning your portfolio around and start, looking and finding some a roadmap to give you the results that you're hoping for the next 5, 10, 15, whatever it may years to kind of set your family up for that. Again, what I mentioned to you, the whole purpose behind what I do here on YouTube and with coaching is to help folks build wealth, but really help them build generational wealth. That's the sole focus for me. I love to see it. And everyone that goes through this academy, they come out and say, I wish I knew this sooner. A bunch of fantastic information. We're trying to make complex things non-complex from that standpoint. I've heard of this. What does it mean? Let's go through it. We go through all of our slides. We have handouts, practice sessions for you to go through to start practicing how to analyze a company, things to look at, how to practice all of the valuation metrics, understanding what are the metrics I need to look at as an investor. How do I calculate them? What do they mean? Where do I get the info from? I'm going to show you where to get it from if you want to do it from a free perspective, which is going to be a little bit more manual intensive. And I'm also going to show you where you can get it from a paid subscription and just rely on it to be able to analyze a company in 1/10 of the time. Now that comes with a paid subscription for the resources I use, but I show both ways to see what's the best fit for you from that standpoint. So I hope you'll be able to join us for our Investing Accelerator Academy. Again, it starts next Tuesday and it'll be every single Tuesday moving forward for the next 6 weeks. So there's 6 total sessions. Each session is roughly 60 minutes in length from that standpoint. We would love to have you and we'll hope to see you there. So that is our stock market after hours. And look at that. We're pretty much back at an hour time. As I mentioned, it's not something that we wanted to hold ourselves to an hour. Sometimes there just may not be a lot of information where we don't just need a blab, just a blab. I want to just tell you the most important information for you to be able to understand as an investor and kind of tell you what I'm looking at from my vantage point there. So again, I thank you guys for joining me overall. It's been a pleasure as always, coming into your homes or wherever you may be and going through this data. So as always, if you haven't done so, hit that like button down below and check out the link also down below for the Investing Accelerator Academy, which we will be jumping into starting next Tuesday, September 10th at 8 p.m. Eastern time. So with that being said, folks, thanks again, and we'll see you next week. Take care.